I got 3.12 million jobs. That's with revisions formed in 2001. That's a slow motion path to 10, 11, 12 million jobs to fully employed America. How does BlackRock frame the goal of fully employed America to all the summer emotions of Fed policy, taper tantrum, Jackson Hole, and what the yield market does? I mean, how do you frame that out, that x-axis?
Yeah, the key is that the Fed has kind of moved its dual objectives towards more favoring of the employment objective relative to the inflation expectations and the inflation objective. And so while in past cycles, this kind of full employment might have led to preemptive Fed tightening, the movement towards flexible average inflation targeting is really a wholesale change in how the market reacts to the payroll figures with respect to interest rate expectations. Now, that doesn't mean that they're never going to raise interest rates, and that's part of the earlier conversation, what followed of the dots. But what it means is that the way we hung on every payroll report is not quite the same as it was when we were kind of growing up. And that's because we've missed on inflation for so long that the Fed is really focused on achieving its inflation target. And they're not going to jump the gun when it comes to full employment. They're going to let the labor market run hot. And today is another piece of evidence that that's working, that strategy is working, the labor market is improving, and that's what they want to see. The risk, of course, what everybody's worried about is what happens if you let the inflation genie out of the bottle. And Powell and the Fed policymakers have been very clear that they're willing to take that risk because the last 10 years, the post-global financial crisis, they've missed on inflation. Inflation's been too low. So we've tilted the axes here, and it's an important change when we read the payroll reports.
Jeff, that's what the Fed says, that they are willing to look past near-term inflation, that they want this economy to run hot, that they are not that concerned about runaway inflation. Is your message from the market that the market doesn't believe them because they believe still, as Priya Misra was saying, at least priced in, and that is sort of the flattening in the yield curve, that there will be a policy error, that they will taper and then hike rates too soon? Is the market misreading what the Fed is saying?
I can understand how a little bit you might interpret the yield curve flattening that way. That I think it would overstate how much of a concern there is right now on the policy error of too fast of tightening. I think right now, mostly the read from the market is that they price in the transitory story. And perhaps the market got a little ahead of itself when it came to the reflationary story. You've got some technicals and trading and momentum strategies, and that's a little bit behind the flattening as well. But mostly when you look at kind of longer-term forward prices of inflation expectations, they're kind of right on the screws of the transitory story, just above 2%. And I think so far that's been, validated by the data. It's still to be seen long-term whether it will be, but that's where the markets are at.